Good morning and welcome to the TR Property Investment Trust PLC Interim Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Marcus Fairmudge, Fund Manager. Good morning to you, sir.
Good morning, everybody, and thank you very much for taking the time to listen to this presentation. It's been over a year since we actually presented on Investor Meets Company, and therefore I decided to do a little bit more of the background about the trust before we move into an update on the how we've been navigating what has been quite challenging conditions. And then move into why we think things are, really probably at a serious inflection point with some sunny uplands on the outlook. So thank you very much for taking the time. I aim to speak for roughly half an hour, maybe 35 minutes, and then hopefully take some questions which will be dealt with by my colleague Peter Brown on our investment trust sales team. Okay, so what we're really focusing on here is the outlook for real estate as the interest rate cycle peaks. So I think our timing is pretty immaculate for that. We're going to try and run through a little bit about us, then the trust, track record, performance, etc., and then the outlook. Now, just as a setting the scene, we actually run quite a range of products at Thames River Capital, which is obviously now part of Columbia Threadneedle. But TR Property is the mothership. It is roughly, we run about 2.2 billion, and the trust is about 1 billion of that. I'm not going to run through the rest of these products. Most of them well, the others are all open-ended. But I would just highlight Property Growth and Income, which is our open-ended daily dealing hybrid vehicle, which is a mixture of real estate and equities. So that's which is never closed to redemptions for liquidity reasons. Quite an interesting product. Anyway, back to the trust. The team is large. We're 12 strong, and as you can see from some of these team tenure figures, they are many of the team have been with me for a very long time. I'd like to call out Alban Lonner, who's the deputy fund manager of the trust, also the lead manager on a number of our other products. George Gay, who's been with me a long time, working on the physical real estate, both in TR Props but also in Property Growth and Income. And Joe Elliott, our finance director, who I joined at Henderson back in 1997. So I've actually been involved with the trust now for 25 years. My wife refers to it as the third child, and I've been running the trust. I took over from Chris Turner in March 2011. So a little bit of background. How do we see real estate? We very much see real estate as an income stream with a capital kicker. For a very long period of time, post the GFC, we really benefited from a very low interest rate environment, and our sector offered a very, very healthy yield comparison, so margin over fixed income. That, of course, came to a juddering halt as we moved into an environment of rising interest rates through the back end of 21 and into 22. And we've obviously been affected by that. But actually, that's only one leg of the property stool, as it were. The other is actually rental growth. Essentially, we're at the growth end of the bond trade or the value end of the equity trade, depending on how you like to look at it. Because essentially, we should be able to provide investors with income that is growing. And it's growing for three reasons. One, because there is tenant demand, which is stable. Obviously, we still have some issues around retail and increasingly offices, but we'll talk about that a bit later. And then really, really importantly for us is actually been the lack of supply of new space. We have a serious shortage of grade A, super prime, energy efficient office space. We have a lot of secondary and tertiary, but we actually have a very high level of bifurcation in that market, with actually rents in the West End back up at peak levels, to give you just one example, and there are many of this. In fact, in a huge number of our submarkets, we have proper supply-demand disequilibrium, i.e. more demand than supply. We're seeing ongoing rental growth in industrial, logistics, last mile urban logistics, big box, etc., self-storage, retail warehousing. Lots of things to talk about a bit later, where we remain very confident about the market. And then the third leg of the stool is actually indexation. Here in the UK, rents are, traditionally you had a rent review after 5 years of your lease, whereas in Europe it's entirely index linked to a greater or lesser extent. So you do actually capture that indexation and that inflationary pressure through the lease on an annual basis. And then the third leg of the underlying real estate equity market is, of course, valuation. And share prices are trading at very large discounts to asset value, and we'll talk about that a bit later on. And as far as we are concerned, they're fully reflecting the debt cost outlook. Okay, and then just to last one on sort of the historical backdrop. This is IPD MSCI data. So this is unlevered direct physical real estate performance. And I use this slide for two reasons. One is to sort of illustrate how steady that dark blue income return is from underlying property, and then of course the volatility in the capital account. You'll see the very dramatic underperformance of the early 1990s. Then the GFC, and then, of course, more recently. And when we look at it, there are essentially two types of illness for real estate. One is the overdevelopment, which then takes a long time to be absorbed through falling rents, as we find a clearing price for occupancy when there's too much supply and not enough demand. Very much a feature of the early 90s. Then, of course, the GFC, a very sharp, dramatic shock in both cost of capital and availability of it. And then more recently, less about availability, much more about cost. And essentially, from our point of view, it is this latter, the rapid change in the cost of capital that is often more aggressive, but shorter lived. And I think that's something that we are very much feeling is the state that we're in at the moment. Very aggressive devaluation, followed by a reasonably swift recovery, quite possibly. And then if we look at exactly what's happened since the beginning of 22, this is the benchmark that TR Props uses. So this is our universe. As you can see, very much 2022 is an annus horribilis. What's interesting is that when we got to the last quarter of 22, excuse me, we actually saw quite a significant rally, and that was the market starting to feel that maybe peak rate was upon us. And then we came back from Christmas, and we obviously had Silicon Valley Bank and First Republic US banking issues and their exposure to real estate. But really what damaged us was a realization that inflation was going to prove much stickier, much tougher to get rid of. And in fact, the central banks really should have really sort of started their rate rising cycle much earlier. And we saw our sector give back over the next quarter. And then sort of the first half of our financial year, so sort of from April to the end of September, as I put in the interim report, we've been bouncing along in this sort of I suppose, a horizontal tube, like a ping pong ball in a horizontal tube, which is a very tight trading range of about 10%. And we've now very recently broken out of that, and essentially that bull and bear peak and trough of that period was all about underlying fundamentals being quite sound, but the market immediately, once we started to rally up, the market then getting bearish about where the cost of capital was and where peak rate was. And I think the comments that we've had literally in the last few weeks, the last month from the Fed and from the Bank of England, ECB, and the data points that we're seeing is a real belief that actually we now are at peak rate, and that's crucially important for real estate. Now, before you think I'm some sort of raving optimist, our central case is that rates remain up at these elevated positions. We don't actually think, we think this is more Table Mountain than Matterhorn in terms of the shape of the curve. And that's just because, there's a lot of geopolitical risk out there. There's a lot of uncertainty around energy costs. We do have full employment. We do have, which on the one hand is a great benefit, and probably leads us to believe that a recession, when it comes, will be quite mild. But I think it's important to know that we're still optimists about real estate equities, but even in an environment where rates remain at these elevated levels. And the reason, quite simply, is this chart. And this is showing you the discounts to NAV. I like charts to go back over long periods of time. And what you can clearly see is somewhere around a discount of sort of 35-40%. The market starts to believe that risk is that the outlook is quite asymmetric, i.e. there's probably a little bit further to go on the downside, but there's really quite a strong positive on the upside. And quite simply, if you found a company where you're confident that its asset values have plateaued, but actually the debt is well fixed, and in fact the LTV is around 30%. The earnings are looking quite solid, but with good growth prospects through a combination of indexation, genuine market rental growth, development opportunities, etc. Then why should these names trade at very large discounts? And history will show you that discount tightening happens really, really quite quickly, and we think that's an opportunity. And in fact, when we look at the performance of real estate equities as a subsector, it has been the top performing subsector of the equity market. In November, our index was up over 12.5% for the month. Okay, and then just to further enhance this point about the performance of real estate, in a rising interest rate cycle, it's clearly been extremely damaged over the last 18 months, 2 years. But what we're showing here is the performance of real estate equities versus global equities after the last 4 cyclical peaks in interest rates. Now, those cyclical peaks were caused. These were all different cycles, and the peaks were triggered by different events. The point is not to analyze why they rose, why particular peaks occurred at different points in time, but just literally, quite simply, how did property equities perform 3, 6, 12 months after those, all very different cycles. And generally, as you can see, the outlook is positive. It does outperform. So my point is, I'm not suggesting that because this cycle has been driven by different factors, it's going to perform differently. It's just a statement about what has happened in the past. And then just coming back now to the trust itself, as I said, net assets of about $1 billion. We're trading at a discount of around 6% today. We are closed-ended. That gives us huge advantages over open-ended. It gives us an opportunity to buy buy into and maintain exposure to smaller companies, because we're not at risk of having to sell them down to return capital at the wrong point in the cycle. We can own physical property up to 15%. We're currently 7%, which of course is quite low for us, but it's reflecting the fact that there is a lot more value in the equity market than there is buying physical. So why buy physical at asset value when you can buy these stocks at big discounts? And then the potential to gear, whilst the max, as far as the prospectus is concerned, is 25%. The maximum we've ever actually had is about 20%. I'd remind shareholders that in the quarter before Lehman, so this is Q2 2008, we were 20% cash. So our spread is 20% cash to 20% geared. We're currently 14%, so we're very much putting our money where our mouth is. I've talked in various articles about our annus horribilis, which was the year to March 23. I think that you're all familiar with what happened. It was the first year that I actually underperformed the benchmark after costs. It was the first time in 12 years. So we have delivered significant outperformance up until, but that was the first year that we failed to do that, the first in 12. And then moving to the current financial year, as you can see, things are a lot rosier, and I'm sure we'll get a chance to talk about that a bit more. And then just this point about relative performance. I'm sorry to sort of blow smoke, but it just needs to make it clear that we are very much active managers. Our job is to deliver you alpha. We're very aware that you all investors can go and buy the ETF of our benchmark, and I need to be able to deliver you alpha as often as possible. Over the last 12 years, that has averaged after costs 400 basis points of alpha per annum. So turning to the dividend, which is obviously a crucial part of the trust. As you can see, we've had very strong 10-year CAG of 8%. The board maintained the dividend at the same as last year for the interim. The chairman also commented about the revenue outlook. The very good news is the board have always been very careful to accrue significant revenue reserves. They total, I think, more than 12.5 pence. So very, very significant. And should there be a period where your revenue drops, which they will be able to use those reserves. And right now, quite a lot of our German businesses and particularly Swedish property companies, not that we have too many of them, but that we do have some, many of those have temporarily suspended dividends whilst they restructure their balance sheets, improve the situation for their for their liabilities on the liability side of the balance sheet. I think it's worth noting that if we had raised the dividend back in 2009-10, even by a smidgen, that would have meant that we would be eligible for the dividend aristocrats, investment trust dividend aristocrats. But in fact, even without entering that particular hallowed group of club of trusts, we do still have one of the strongest growth rates of all trusts. And then looking at the fund itself, we're unashamedly pan-European. As you can see, we have more equities in continental Europe than we do in the UK. However, relative to the benchmark, we are overweight the UK. And then the way we look at the world we're not entirely geographically focused. That's not what drives us. What drives us is really looking for those sectors which have fundamental upside. And on the left-hand side, you can see the way we divide the world into these 26 different groups. Some are companies that then are all sitting, pan-European, like industrial. We group them all in one group because ultimately what's driving at the macro level is nearshoring, onshoring, a little more just in case, a little less just in time. All of these factors affect all companies, regardless of geographical jurisdiction. Meanwhile, when it comes to retail, we separate retail into UK, London, and continental Europe. Essentially, we separate London from the rest of the UK because it's dominated by tourism, both domestic and international. And then we separate UK and Europe because they really are extremely different drivers. The UK has a very high level of online. We're up to about 35% of all sales are online now. Meanwhile, Italy, that figure is about 12%. In addition, UK shopping centres have been dominated and anchored by department stores, which is a failed concept now. Meanwhile, continental Europe, the vast majority are anchored by hypermarkets. So there are many other differentiating factors, but that's what we're just to give you a bit of a snapshot, and we can happily talk about any other breakdowns that you'd like to. On the right-hand side, you'll see where our exposure is relative to the benchmark. So here, this is all about our stock selection. So we find sectors that we feel are fundamentally attractive, but then importantly, we've got to then be able to find companies that we are confident the price of those businesses today will still give us the upside that we want, i.e. they're not too fully priced. If you take a sector like student accommodation in the middle of that chart, we're very optimistic about student accommodation and rental growth. So you'll say, well, why don't you own more of it? The answer is we do. We have exposure to Unite in the UK and to Exior in Europe. But we feel that these stocks are fully priced, and therefore it's a neutral weighting for us. So our weighting relative to the benchmark is neutral in that case. Okay, I'm going to brush past this, so you may have some questions about some of these companies, but you can see, just in the last few months where we've been positioning, where we've been taking profits. We continue to be very concerned about offices in the UK and in parts of Europe, but not all of Europe. We're much more optimistic about Paris, for example, than London. And then deep value coming back, and these very interest rate sensitive names such as Vonovia and TAG, and then very deeply discounted businesses that we think are very well run, have long dated debt, such as Picton, are a really interesting case, but we can talk about some more of those in due course. And then something which is, I think, really important and very much close to the business model of TR Props, but also to the wider market, is the fact that real estate, much more real estate is owned privately than publicly. We think that only less than 15% of all commercial property is actually owned through the listed market. It's a bit higher in the US and a bit lower in and therefore lower in Europe. But there's really no reason why these companies will exist if they're going to continue to trade at very large discounts to asset value. The private market will come and privatize, which is what you can see on the right hand side. Now, we haven't seen much of that recently, the exception being industrial REIT, which I'll come back to, but generally that's been where capital has been very cheap. So the likes of Brookfield and Blackstone and Oaktree, the highly levered private equity players, they're not really in the game at the moment. So we expect to see less public to private. But on the left-hand side, we do expect to see more consolidation. There are many listed companies that are too small. They need to get together. And we would applaud the management of Eddystone, the board of Eddystone, who announced carried out a strategic review in March, where they basically said, look, our management team have done a great job. They sold all their offices. They are 100% retail warehousing, which is a subsector that's been doing very well. But we're just not big enough. And we need to, be part of a bigger animal. And in the end, that they carried out a sort of quasi auction process. And in fact, the highest bidder wasn't another listed property company in the UK. It was actually a US REIT called Realty Income. Realty Income is actually a 36 billion market cap REIT. It's absolutely huge, and it's been busy raising capital in the US and buying assets in the UK as well as in the US. And then the merger of London Metric acquiring CTPT for paper. We own 10% of CTPT. We owned 16% of Eddystone. Looking back further up, we owned 10% of Mackay Securities. And then just coming back onto the other side to Industrial REIT, which was a deal that happened where Blackstone bid for Industrial REIT on the 3rd of April this year. So just at the beginning of the current financial year, that was a 40% premium to the undisturbed share price, i.e. the stock market had been far too miserable about the prospects for Industrial REIT, and actually a 17% premium to the last published NAV. We've been very busy buying lots of shares in Industrial REIT. In fact, we owned about 12% of that. So two things are happening here. One, I am focused on a lot of these small caps and trying to encourage boards to either get together with similar motivated companies or to look at how to close the discounts that they're standing at. But also just generally, it's a great underpin for the market. It just reminds investors that, if the equity market leaves these companies too cheap, then we will see them being taken private. And then if I just like to touch briefly on the before we move to the outlook, on the physical real estate of the trust, which is only about 7% at the moment. But I would like to highlight our industrial estate in Wandsworth. Really, in industrial terms, this is super central London. There's very little industrial space left in these very central locations. And what you could see on the right-hand side, we've owned this, by the way, for a very long time. I actually bought this estate in 1998, but you can see that, through the early 2000s, the rents remained, the rental growth was quite modest. And then from about sort of 14, 15, it's absolutely rocketed. And this is all about online and B2C and B2B. This is super central, and the tenants in here have a wide range of uses, but a lot of them are supplying goods and services into central London, and they need to be as centrally located as possible. And then on our ESG credentials, obviously, clearly our underlying companies are all very busy improving their ESG credentials all the time, and we are absolutely backing those that are doing the right thing. But more importantly, we need to do that ourselves, and we need to be able to prove to shareholders that we are taking direct action. And at Gloucester, we're putting solar panels across all of our roofs. All of our leases are green leases. New leases are green leases, i.e. we insist on our tenants buying their electricity from an accredited provider. And then on the right-hand side, Wandsworth, we are busy starting a refurbishment program of our units on a staggered basis, which means we generally have one vacant unit at a time. And we had initially had a Ukrainian charity, and now we now currently have the Wandsworth Food Bank occupying this space. So always trying to do what we can for the local community. And then just sort of pulling it all together, our outlook is very much based on the fact that we think we're probably beyond the point of macro uncertainty now. We think that rates have certainly peaked. There has been this massive expansion in bond markets and reduced liquidity, and the price correction is being very much being felt out there in the physical market. But real estate equities are trading at very significant discounts. We have taken a huge amount of this pain. And essentially, the equity market is a forward-looking discounting mechanism. So when I go to see my colleagues who are running physical property funds in other parts of the business, I'm very much, hi everybody, I'm the ghost of Christmas future, in as much as the physical market is still going to see further price falls, value falls, but we have seen, we have already more than compensated for those anticipated falls in the price of real estate equities. And in fact, many of our sectors, and we've seen lots of evidence recently of deals done in prime offices, logistics, industrial, retail warehousing, self-storage, primary healthcare. These markets are absolutely fine, and there's evidence of buyers. And then crucially, very little sign of corporate distress at the moment. And if anything, the sort of dirty secret for real estate is that it's okay if the recession is mild. That's not a bad thing. We don't want many companies going liquidating or leaving space and creating vacancy. But if that mild recession encourages central banks not to raise rates any further, then that's a really, really good, strong, positive message for real estate, which of course is pricing that income stream. And then I really want to highlight the fact that the LTV of the listed real estate space, pan-European, is about 34% collectively. It's lower in the UK, it's kind of around 30, and it's a bit higher in continental Europe, probably 36 or 37. But these numbers are very comfortable relative to private businesses, many of whom their business models were predicated on very large amounts of debt, very cheap debt, and that debt, has to come to an end. It's not perpetual. Often it's a 3 or 5 or 7 year life, and it's no different to your fixed rate mortgage coming to an end. It's extremely painful right now for those customers. Whereas our listed space, not only have they always been much more conservative about this leverage, but the equity market has forced them to identify those businesses that are at risk and do something about it. So we've seen a lot of value degradation, essentially through swaps and caps and new debt facilities being put in place. But we've experienced that, and we have been able to avoid the worst culprits. Who had too much floating rate debt, etc., and very much back those businesses that have longer placed debt or just fundamentally lower leverage. So there are many of those which we're able to own. And then finally, that bullet point about renewed M&A activity. I mean, we've obviously benefited this year with Industrial REIT, with CTP, with Ediston, and then there's been some sort of market noise around UKCM and Picton, so we may have questions about that, and I think there will be other opportunities. I think all boards need to be looking at their companies if they're trading on very large discounts and saying, well, is it fair and reasonable for the owners of this company, the shareholders, that we continue to languish at these wide discounts? I think there's a lot to be done about that. Okay, well, there's some data that we're required to put in for regulatory purposes, and then really that brings to an end the formal part of the presentation. I think I've done it in 33 minutes, so I've probably gabbled far too much, but I think hopefully there'll be a few questions, and that'll be able to flesh out some of the points that I've been trying to make. So thank you very much for listening to me.
Perfect, Marcus. Thank you very much for your presentation. What I'll do is I'll just bring your camera back up now for the Q&A. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to read those questions submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Peter, as you can see, we've received a number of questions throughout today's presentation, and if I could just hand over to you just to chair the Q&A, that'd be great, and I'll pick up from you at the end.
Sure, thank you, and thank you everyone for joining us today. We've had a few pre-submitted questions which we've answered before the meeting. You'll find them on the website. But we'll start the live questions by Marcus. You mentioned interest rates a couple of times. You suggested that it's rates will remain elevated, a table mountain sort of plateau rather than a sharp up and a sharp down. There's a couple of questions about interest rates, but if I can amalgamate them into one, how is your view on interest rates impacting your investment strategy over the next 12 months or so?
Yeah, I'm glad there's been multiple questions on this, and I had expected that to be the case because it is central to the outlook. So we have to form a judgment as to where we think rates are going to go and why we think they're going to be elevated for and remain around these levels for the foreseeable future. And essentially, it's around the fact that there's full employment, we have geopolitical risk. There is still drivers of that are going to keep inflation up at these higher levels. We think now, if we are wrong. And the recession is harder and rates come down faster to compensate for that, then the fact that we are a leveraged asset class is going to work in our favor. If we're wrong and inflation is there's a resurgence and central banks feel they need to put rates up further, then that of course will impact us. But I think we are of the view that that middle ground where we are is the right place to be. Now, essentially, if you think about the implied yields that are being thrown off by the equity market at the moment, we have many sectors where the implied yields are 7-8%, and the cost of money is lower than that. Where you have implied yields that are lower, i.e. around today's cost of money, they can only remain there if there is if those companies are able to capture rental growth. That rental growth might be through a combination of indexation, through reversion, through market rental growth, or a development program. So, essentially what we are looking at is focusing on those companies where we see that growth. So we are a owner generally of quality businesses where the balance sheet doesn't have a lot of near-term refi. So we're not, but where we can see that top line growth through their underlying activities and the quality of the portfolio. So, and we need to see that earnings growth not get denuded by increases in their debt costs. Those businesses which have shorter dated debt and where there is still some painful refi to come, that of course has to be reflected in what we're prepared to pay. So there are other businesses which are relatively high yielding, and their implied yields are quite high, where we're happy to own them because we're still getting that margin over cost of debt and those high that high dividend yield, but we're also reasonably pessimistic about them able to grow earnings in the short run. So it's I'm hoping that I'm covering the question, but maybe Peter, if you feel not, just we'll finesse it further.
No, that's fine. I think, but we'll stick on the macroeconomic factors. There's a question other than obviously looking at the debts that some of your universe has and how they manage that. How are you managing what risk management strategies are being employed to safeguard the portfolio is the question, basically, other than looking at the debt of the underlying.
Yeah, so the trust, this is all about the trust gearing. So we have a little bit of, our gearing of 14% is split into sort of three pieces. The first is that we have some fixed rate debt, and you can see that in the annual report. We have 50 million euro 2030, which is at 1.9, and we have 15 million sterling, which I think is 2028, so it's a bit shorter dated, about 3.5%. So there's a bit of fixed debt. The rest of it is through RCFs, and then we use CFDs, which are the same price as RCFs, but just enable us to avoid the stamp duty and financial transfer tax in France. So we use that CFDs for buying some of our UK and French names. But essentially that is, we're borrowing at today's current floating rate debt. Now that can all be paid back extremely quickly. So if we feel that markets we're getting this wrong and the outlook turns more bearish, we can reduce that debt very dramatically. I think investors should also appreciate that we do have 7% of the portfolio in physical property. So if our gearing is 14 and essentially half of that exposure is to off benchmark unlevered physical real estate, then the movement in the price of the unlevered physical real estate is not as dramatic as that of the equity market, either on the way up or on the way down. So we are less geared to the equity market than say the 14% would have you look. The other way that we safeguard what we're doing is there are a number of places that offer us that are safe havens in difficult times. We have over the years been very long of Swiss property, where inflation is very, very modest at the moment. But the other natural way to seek safety is to get into those businesses, as we did do last year, those businesses which have the safest balance sheets. And avoid those with the which are most levered. But right now we're operating quite a barbell approach where we've got a lot of quality companies with quality balance sheets, but actually in the last couple of months we've bought into some quite high beta names. These are names that have been smashed on the way down because of expectations of of rising interest rates, or the impact of the interest rate curve looking forever upwards, and then of course we've benefited significantly in the last sort of 2 months from a number of those names repricing to reflect the fact that the curve is flattening. And I would call out a business which is a very well run business but has a lot of debt in Sweden called Balder, where we've made about 25-30% on our position in the last couple of months there, just because it's a very high beta name. But we are very cognizant of where the sensitivity for quite a lot of our companies, and we need to make sure we rotate out of those if necessary. But we run about, there are about 120 companies that we look at. There's 107 in the benchmark. We then have some other off-benchmark stocks. I've got a very strong team. I've got two analysts, plus there are 2 fund managers. I've been doing this for 25 years. There's a lot of things in here that we're very cognizant of what drives markets, both short term and longer term.
Thank you. Right, next point is regarding perspective on future merger and acquisitions in the sector. I know you've mentioned it a few times, but maybe if you can summarize your thoughts. But also there's been a couple of questions specifically. Can you please discuss Picton's proposed merger, which I assume is with UKCM, which is now not necessarily going ahead? And there's another question regarding the Edison situation, regarding why you were happy to take a discounted price once that M&A went through.
Yeah, those are excellent questions. So I'm going to just try and deal with them all. I think the broad point is the one that I've made in various annual reports and quite a lot of published articles, is that essentially there are huge economies of scale from amalgamating these businesses. If you see the evidence with Edison, with the acquisition of CTPT by London Metric, and Mucklow being acquired, Mackay being acquired by Workspace. The acquirer didn't take many, if any, of the staff of these businesses, and that's because you can bolt on the management of these assets to your existing infrastructure. So first of all, there are earnings gains. Secondly, the owners of a lot of these companies, if you look at the registers, are the wealth management communities, and we've seen a huge amount of consolidation and amalgamation in their business models. And really, there's you talk to them. There really is a cutoff, a minimum at which they really want to own these businesses, because they also need liquidity at the equity level. So I think there is a lot of drivers for this consolidation. A lot of these externally managed businesses were created in a period of very low interest rates, and they were absolutely valid business models. They were offering clients exposure to different sectors, be it healthcare, supermarkets, retail warehousing, etc., and delivering a healthy dividend return. But actually, there wasn't a lot of asset management in much of this. A lot of this is long income, and it can be done a lot more cheaply than these vehicles are being currently run at. So I think there is consolidation. I think there has genuinely. I've been over many years talking to boards. There's been resistance. Turkeys don't vote for Christmas. It's pretty obvious. I'm not saying anything that's at all controversial, but I think now we're at a point when we've seen a number of these situations evolve, that actually it's very hard for boards to ignore it. I mean, you cannot, if you're sitting on a 30 or 40 discount, you can't just say to the owners of the company, well, we're just going to carry on. It's fine. It'll all come good. Because it won't, because there are now, your typical, your probable buyer, of marginal buyer was a wealth manager who just says, well, no, I've now running billions and billions and billions of AUM, and I can't possibly start to add to a position. I don't want to own 20, 30, 40% of a 250 million market cap company. So, and we just have to, as shareholders, we have to keep messaging to boards that something has to be done about this. And there are clear benefits from M&A. So that's the first point. The second one is which is an excellent question about why did I accept a 10% discount to the NAV for the Edison deal. And I think what happened with the Edison deal is, I talked about why I was impressed with the board for doing what they did, because essentially they were falling on their sword. They were doing the right thing for shareholders, and they acknowledged in the strategic review statement back in March that they felt that they were never going to be able to return to asset value. The share price wasn't going to get back to asset value, and therefore that's why they needed to do something about it. And they wanted. I could see reading the statement that they would have preferred consolidation, but the best price came from a cash buyer. Now, that's the point. They went into a process, and that process revealed that the best buyer in the market was a cash buyer. Maybe they had other bids for paper, but those numbers were lower. So actually, to me, this just reminds all investors, and it should remind all investors, that NAV is a snapshot valuation carried out by a third party, looking in the rear view mirror, sometimes with lots of evidence, sometimes with little evidence. And it always frustrates me that the stock market, particularly the analyst community, say, oh, X and Y company has missed its NAV by 3 pence or 0.5% or whatever. Because at the end of the day, valuation is an art, not a science. And I would, if any of you know any surveyors and they will all have spent some time during their training working in a valuation department, it really it's not as, unfortunately, it's not like the equity market. You don't just turn on your screen and take either the bid or offer or the mid, and the spread is 1%. And I would just implore everybody on this call, if you think about it, if you ask an estate agent, 3 estate agents to come and value your house or your flat, or wherever you live, the spread will be, and these will be in liquid markets, the spread will probably be 5 or 10%. So, NAV is not some sacrosanct figure. And the fact of the matter is, clearly the valuers, and I'm not blaming them, but in the instance of Eddystone, there was then a full, essentially the board must have conducted a full marketing. I mean, I wasn't aware of it, but they must have conducted it, and that's the auction process, and the price was revealed to be lower. So it wasn't that the market price was wrong, it was that the NAV was wrong. Now, that applies to the world we're in. And when we look at these discounts to asset value, when you see a company trading at a 35 discount to asset value, do I think that I immediately could demand a breakup of that company and recover all 35% of that discount? No, absolutely not. I realize that in some cases that NAV is very backward looking. Interestingly, in the UK, valuations are much more accurate and much more up to date than in continental Europe, particularly in Germany, where they very much mark to model rather than mark to market. So they tweak the discount rate. They tend to view a lack of market evidence not as a precursor of a collapse in values when the buyers and sellers are too far apart, but very much as we can't see the evidence, so we're not going to do anything about it. That's, I think, the wrong approach, and that's why we're more sanguine about those discounts in some European stocks. But yeah, I think that's. I hope I'm making the point. The last one was a question about Picton and UKCM. Essentially, for those of you who are not familiar with this, there were clearly discussions behind the scenes and then Picton came out with an announcement, and then UKCM also came out with an announcement saying they'd been approached, and then we had this strange announcement that the UKCM has a very large shareholder called Phoenix Life. This is a life assurance business that said that they're not interested in a transaction like Picton. And I can't answer for Phoenix, and I don't really know why they rejected it, except that I think it probably it's just interesting that therefore these companies are Picton clearly is up for being part of the consolidation process, and I'm welcome the fact that the chair of Picton, Lena Wilson, has been very open about the fact that she wants her company to be bigger, to be part of something bigger. So that's to be applauded. But where things are at the moment, who knows what there is a new chairman at UKCM, a chap called Peter Pierre Gray, who spent a lot of his career building the real estate business at the Wellcome Trust. So he's clearly a very, very smart individual. I haven't yet met him, but I'm going to meet him, and we'll see what his thoughts are about the situation.
Okay, lovely. We've still got a few more questions. We'll try and get through them all. We've got about 10 minutes left. But next question. A number of REITs have trumpeted underexposure to industrial assets as yield has been low relative to rising interest rates, resulting in loss of capital value. Why do you take a different view?
Yeah, it's a good way of you're kind of looking at it, telescope the other way around, the way we look at it, which was that there has been a huge structural tailwind for industrial property, which I've already talked about, and that has manifested itself in very strong rental growth over the last 5 or 6 years, and that, of course, in the bull time, that drove yields for industrial assets lower and lower, because quite simply, when you could borrow money at 2%, and you could buy an asset that was yielding you 5%, but it had rental growth of 5% per annum. Well, sure enough, that 5% yield was going to be bid down to 4.5 or 4 or even lower. Because clearly that rental growth was attractive, and the community, the investment community, felt that was baked in. Now, of course, this, with yields which were very low, the same applied to German residential. These very low yields, because they were seen as very defensive assets with growth, experienced the sharpest repricing, because when you move a yield from 3% to 4%, even on a gross basis, you lose 25% of the value. So you've had a very sharp return, and that's been very damaging for a lot of these names. But you had enjoyed tremendous growth on the way down. Our view here is that there has been a huge amount of repricing. If you look at the likes of Segro, the share price peaked at £14, it got down to below 7. And today it's £8.16 live price. So it's taken a lot of pain, and we feel that it still has rental growth. Now there are other names that we are even more positive about, like Tritax Big Box, London Metric, but increasingly in Europe, Argan, Catena in Sweden, Argan in France, Monteir in Belgium. My point being, these are companies you wouldn't necessarily know, but we are deeply knowledgeable of and very embedded in. What it's all about for me is the ability of these businesses to build out their development programs. There's huge value to be made, because there is essentially a continuing shift to nearshoring, onshoring, nearshoring, shortening supply chains, increasing your amount of storage of stuff that you need. You don't want to rely on getting on a crucial part coming from a far-flung part of Asia. You need to get that closer to home. And then, of course, the appalling disaster of Brexit and the appallingness of Brexit. I'm a rabid Remainer, is of course that we are going, one of our costs for the UK is going to be that we're going to have to store more of this, more of everything on our little island, because there will be moments where we may not be able to get access to it. So I think there is this structural tailwind which is helping us. Okay, I think that covers that one.
Yeah, I think that's fine. We'll move on slightly to weightings. Why are you so underweight Switzerland and so overweight UK residential relative to the benchmark? And I'll include another question. Is the German residential market a concern for you?
Okay, right. Sorry, Peter, just to be clear, I think it's a question about overweight UK retail.
UK retail, yes.
Yeah,
sorry.
Yeah. Okay, so the underweight Switzerland, quite simply, is about valuation of the underlying companies. These are great businesses. It's a good market. It has low inflation, but this is a classic case of where we're totally comfortable with the market, but the stocks are just fully priced as far as we are concerned. They are very defensive, but we're at a moment where the tide has turned. We've seen very strong performance from high beta names, and the Swiss companies are low beta. So this is a tactical shift, part of our barbell approach. In terms of retail, that statistic is purely to do with Eddiston. We are still Realty Income bought the assets in Eddiston. They didn't buy the company, and the board have announced that the proceeds will be returned to investors in January next year. In the meantime, they're still going to pay the monthly dividend. So essentially, we're getting about a 7% annualized return on that income. on that capital. I am actually I have been selling some of our Edison. I'm using it as a sort of little cash pile, as and when we need to find better things to invest in. There is a rinky dink though, which is that in the statement published by the board post the transaction, it does say that should the existing management come up with a use for the proceeds that the board thinks is in the interest of shareholders, then they might have a mind to consider what that might be. So there is a risk that the company does doesn't return the capital and does find a use for it. Now I say it's a risk, but it should be risk to the upside, because the board clearly won't allow the management company to spend the money on anything that isn't going to be clearly accretive. But at the moment I'm able to use that as a sort of piggy bank to take cash out. At the same time, I've closed the underweight to Hammerson. This was some time ago. We're not fans of this company. We think it's a breakup. We were very, very short in the name for many, many, many years, whilst it was busily being driven into a brick wall by the previous management. Now it has new management, but it's a breakup situation, and there has been a lot of publicity about the potential of it selling its retail warehouses, its premium outlets. The one that many of you will be familiar with will be Bicester Village. Unfortunately, they don't own Bicester Village, nor do they own part of it. They actually own shares. They're a minority shareholder in bits of in the underlying company, so they don't actually have control. So that's very different. If they owned it, then we would almost certainly be staying with it, because we're very big fans of outlet malls. If you look at something like Gunwharf Quay in Portsmouth, which is owned by Landsec, that's done incredibly well. Okay. Peter, what was those? Oh, residential, German residential. Yes. German, just very briefly, German residential, fascinating area. Market fundamentals are very strong. There is no vacancy in German residential. There's a queue of tenants. Rents are on average about 65% of open market. It's very, very secure income. It is index linked to some extent through something called the Mietspiegel, which is the rent table. It's backward looking. So traditionally it's only been around 2%, 2.5%. We think that's going to increase because it's going to capture some of last year's much greater inflation data. But the real problem with these businesses is the amount of debt they have. Many of them have cut the dividend, or suspended the dividend. TAG, LEG, Aroundtown, Grand City, Vonovia have cut theirs. But of course, they're incredibly interest rate sensitive. And to give you Vonovia, the largest property company in our universe, share price has gone 55, 17, 17, 25. So there's been a very, very dramatic recovery. So this is interest rate sensitivity at its ultimate. We also own a business called Phoenix Breed Deutschland, which owns a really, really high quality portfolio of Berlin apartments, and it's an externally managed business. It has a continuation vote next year, and essentially the board have incentivized management to return capital by paying them a percentage of proceeds. So we think that's a business that will slowly over time sell assets to help us on the journey. The asset value is it's a sterling listed company. Asset value we think published is about £4.30. We think that real number is about £3, reflecting the fact that the German valuers are behind the curve, and the share price is £1.60. So you're being, again, this is where we think the asymmetric, that the risk profile is asymmetric, and we're reasonably confident that we will see strong returns of capital from that business over the next couple of years. Okay, next please.
Well, I think that we'll have to call a halt there. We're just coming up to the hour. We do have a few more questions that we'll get to post-meeting, and we'll put them on the website. And we will be doing more of these IMC webinars in the near future, so we can approach more questions then. But if that's okay, I'll pass back to Alex now to conclude.
Yeah. Okay, well, Alex, I'm just going to cover off so that we don't have to spend time thinking about it. There's a question about the Wandsworth Food Bank. This is all about our ESG strategy. This is a temporary let. So we do not charge the tenant, and it's only while we have a vacant unit while we're carrying out refurbishment. So this is literally just, we can't put a tenant in for a proper rent-paying tenants in for a very short period of time. So we've taken advantage of the fact that we know this unit has to be empty for a few months. So we are doing what we think is something that shareholders will be happy with, is we're making sure that somebody who has a need is able to use that space temporarily at no cost to them and a very, very modest cost to us.
Perfect. I'll just jump in there. Marcus, Peter, thank you very much for that. I think you've addressed those questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Marcus, could I just ask you for a few closing comments?
Well, all I would like to say is thank you very much to everybody who's really hung in there and listened to me for a whole hour. That is very generous of you, and very happy to take further questions. Do remember there is an inquiry box on our website, trproperty.com. There are articles that we've written about and various publications, as well as, of course, the interim results, the full manager's statement, chairman's outlook, etc., which is, I think, also of use to investors. And all I'd like to say is thank you very much for your time and for your support, and have a lovely weekend.
Perfect. Marcus, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of TR Property Investment Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.